You know, most people think money problems start because they don't earn enough. That's the story we like to tell ourselves. It's comforting. It shifts the blame outward. If only I had a higher salary, a better job, more opportunities, then everything would fall into place. But after watching markets, people, and human behavior for decades, I learned something far more unsettling. Income is rarely the real problem. Behavior is. I grew up in a time when money could disappear overnight. I was born in 1894, and by the time I was a young man, I watched the Great Depression erase fortunes that took lifetimes to build. These weren't foolish people. They were intelligent, hardworking, respected members of society. They read the newspapers. They followed the experts. They did what everyone else was doing, and that was exactly the problem. Most people don't lose money because they make one terrible decision. They lose money because they repeat small, reasonable-looking mistakes for years. They confuse effort with progress. They confuse activity with intelligence. They confuse hope with strategy. Early in my career, I noticed something that contradicted everything people believed about investing. The investors who survived, who quietly rebuilt, and eventually prospered, weren't the bold ones. They weren't the loud ones. They weren't the ones constantly trading, predicting, or reacting. They were the calm ones, the patient ones, the ones who understood that money rewards temperament far more than brilliance. That realization changed how I thought about finance forever. People like to believe wealth is built through cleverness, the right stock, the perfect timing, the secret insight no one else has. But the truth is less glamorous. Wealth is built by consistently not doing foolish things. That's it. Avoiding stupidity beats chasing genius every time. The stock market, like life, punishes impatience. It rewards discipline so slowly that most people give up before the reward ever arrives. They want proof immediately. They want excitement. They want reassurance that they're smart. And so they trade, speculate, borrow, and panic, all in the name of feeling productive. But productivity in finance is often invisible. I used to tell my students that the market is not a machine for making you rich quickly. It is a machine for transferring wealth from the impatient to the patient. That statement made people uncomfortable because it implied something deeply personal. If you fail financially, it's not because the market is unfair. It's because you couldn't control yourself. One of the most dangerous illusions in money is the belief that motion equals progress. People feel productive when they're busy, buying, selling, adjusting, reacting, checking prices, reading predictions. But most of that activity does nothing except generate fees, taxes, and stress. Real progress often looks like boredom. There is a simple mathematical truth that governs all wealth creation, and it has nothing to do with intelligence. It's compounding. Small amounts, left alone, grow slowly at first, and then explosively later. But the early years are discouraging. The numbers are small. The progress feels insulting, and that's where most people fail. They don't fail because compounding doesn't work. They fail because they don't let it work. I watched people abandon sound investments because they were only earning modest returns. I watched others chase excitement and lose everything. The difference between the two wasn't knowledge. It was temperament. One group could tolerate boredom, the other couldn't. This is why I always said that the investor's chief problem, and even his worst enemy, is likely to be himself. Human psychology is poorly suited for modern finance. We evolved to react quickly, to follow the crowd, to avoid short-term pain. Those instincts kept our ancestors alive. Today they keep people poor. When prices fall, fear screams at you to sell. When prices rise, envy screams at you to buy. Neither voice cares about long-term outcomes. The market doesn't reward intelligence evenly. It rewards emotional control disproportionately. I learned this lesson painfully early. In my younger years, I made investments that looked excellent on paper, but ignored a crucial concept: margin of safety. I assumed I was right. I assumed conditions would remain favorable. I assumed the future would resemble the past. Those assumptions cost me money. Not ruinous amounts, but enough to leave a permanent mark. From that point on, I built my philosophy around one simple idea: never put yourself in a position where being wrong destroys you. That principle applies far beyond stocks. It applies to personal finance, careers, and life itself. Most financial disasters don't come from low returns. They come from leverage, overconfidence, and living without buffers. People stretch themselves thin because everything looks fine until it isn't. Markets fall, jobs disappear, economies slow. These are not surprises. They are certainties. The only real question is whether you prepared for them or pretended they wouldn't happen. The people who survive financial storms are rarely the ones with the highest incomes. They are the ones with the lowest fragility. They have savings. They have flexibility. They have options. They built their lives with room for error. This is why I always emphasize the importance of capital. Not income, capital. When you sell your time, you get paid once. When you own capital, it can pay you repeatedly. That distinction is everything. Until you understand it, you will spend your life working harder without moving forward. Many people are trapped in what looks like success. Nice homes, new cars, respectable titles, but no freedom, no margin, no ability to stop. They earn well, spend everything, and call it progress. It isn't, it's just motion. True financial progress is quiet. It doesn't announce itself. It doesn't impress your neighbors. In fact, it often looks like underachievement for a very long time. And that's why so few people stick with it. The beginning is always the hardest. Saving feels pointless when the numbers are small. Investing feels slow when results don't show up immediately. Discipline feels like deprivation when everyone else seems to be enjoying life. But that discomfort is the price of independence. I often said that an investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. Everything else is speculation. The same logic applies to personal finance. If your financial life depends on everything going right, it isn't safe. It's speculative. Safety comes from simplicity, spending less than you earn, avoiding debt on things that lose value, investing in what you understand, leaving enough room for mistakes. Then waiting. Waiting is the hardest part. Waiting forces you to sit with doubt, with boredom, with uncertainty. But waiting is where the real work happens. While you're waiting, compounding is working, quietly, relentlessly, without emotion. Most people never experience the power of compounding because they interrupt it too early. They pull money out, they chase something better, they react to noise, they reset the clock again and again. Then they conclude that investing doesn't work. It works, just not on their timeline. I watched generations repeat the same errors because human nature doesn't change. Technology changes, markets change, products change, but fear, greed, envy, and impatience remain constant. And because they remain constant, the same principles keep working. The investor who wins is not the one who predicts the future. It's the one who prepares for uncertainty. The one who accepts that being average, consistent, and patient beats being brilliant and reckless. This philosophy isn't exciting. It won't make you popular at dinner parties. It won't give you stories to tell about daring bets or lucky wins. But it will quietly build something far more valuable than excitement. It will build security. And security, once you have lived without it, is priceless. What most people fail to grasp is that the market doesn't test your knowledge first. It tests your emotions. Long before your intelligence ever matters, your ability to remain calm under pressure is put on trial. Prices fall, headlines scream, friends panic, And suddenly, every rational plan you made in a quiet moment feels foolish. This is where wealth is either preserved or destroyed. I saw this again and again. Investors who understood the math still failed because they couldn't endure discomfort. They knew prices fluctuate. They knew markets recover. But knowing something intellectually and living through it emotionally are very different experiences. When fear arrives, logic often leaves the room. That is why I always emphasize defensive investing. Not defensive in the sense of being timid, but defensive in the sense of being prepared. A defensive investor accepts one uncomfortable truth. You will be wrong sometimes. The future will surprise you. Markets will behave irrationally. And because of that, you must build your financial life so that mistakes are survivable. This is where margin of safety becomes more than an investment concept. It becomes a way of thinking. You don't assume best-case scenarios. You assume ordinary human error. You assume setbacks. You assume bad luck will visit at inconvenient times. And then you structure your decisions so those moments don't ruin you. Most people do the opposite. They plan their finances as if nothing will ever go wrong. They borrow to the limit. They spend every raise. They assume steady growth. And when life inevitably breaks that illusion, they call it bad luck. It isn't. It's fragility. Financial fragility is the real enemy, not low returns. I learned early that debt magnifies human weakness. Borrowing creates pressure. Pressure creates panic. Panic leads to bad decisions at the worst possible time. This is why leverage looks intelligent during calm periods and becomes lethal during chaos. People underestimate how irrational they become when survival feels threatened. You may believe you'll stay calm in a downturn. Almost everyone believes that until they experience it. When your savings are thin and your obligations are high, fear speaks louder than reason. This is why safety must be built before returns are chased. One of the quiet tragedies I observed was how often intelligent people mistook confidence for competence. A few good years made them feel invincible. They increased risk. They ignored valuation. They stretched beyond their understanding. Then one bad cycle erased a decade of progress. Overconfidence doesn't announce itself. It feels like clarity right until it fails. True discipline is not confidence. It is humility. Humility means admitting you cannot predict markets reliably. It means accepting that simple strategies, executed consistently, outperform complex ones driven by ego. It means understanding that the goal is not to win impressively, but to avoid losing disastrously. I often reminded investors that stocks are not lottery tickets. They are ownership shares in real businesses. When you buy a stock, you are buying a future stream of earnings, not a price movement. If you forget that, you will behave like a gambler instead of an owner. Owners think differently. They care about durability, about balance sheets, about cash flow, about staying power. They don't panic because the price moved yesterday. They focus on whether the business itself is still sound. Speculators, on the other hand, are obsessed with price. They don't ask what something is worth. They ask what someone else will pay for it tomorrow. That mindset guarantees emotional instability because it depends entirely on other people's moods. The market is a voting machine in the short term and a weighing machine in the long term. In the short term, emotions dominate. In the long term, fundamentals assert themselves. If your behavior is anchored to the short term, you will always feel out of control. This is why patience is not a passive trait. It is an active advantage. Patience allows the weighing machine to do its work. Impatience hands control back to the crowd. I watched entire generations miss extraordinary opportunities simply because they couldn't sit still. They sold good assets to chase better stories. They abandoned discipline to relieve anxiety. They turned temporary declines into permanent losses. The cruel irony is that the greatest financial rewards often arrive after the longest periods of discomfort. Markets don't compensate you for taking risk. They compensate you for tolerating uncertainty. Another misconception that traps people is the belief that wealth should feel exciting. Excitement is usually a warning sign. Excitement means emotion. Emotion means poor judgment. The most effective financial decisions are often deeply boring. Saving is boring. Index investing is boring. Waiting is boring. But boredom is stable, and stability is where compounding thrives. People underestimate how much damage impatience causes over decades. One impulsive decision doesn't seem fatal, but repeated small lapses accumulate. Selling early, spending prematurely, chasing trends. Each one looks harmless in isolation. Together, they quietly sabotage the future. I saw people with every advantage fail because they couldn't control lifestyle inflation. As their income rose, their expenses followed closely behind. Every raise became permission to consume more. And so, despite earning well, they remained financially fragile. Wealth is not what you earn, it's what you keep. This is a hard truth because it requires restraint in a culture built on consumption. Advertising exists to convince you that satisfaction is one purchase away. Social pressure reinforces the idea that success must be visible, but visible success often hides invisible weakness. I never cared about appearing wealthy. I cared about being secure. The two are not the same. In fact, they often move in opposite directions. There is a quiet power in living below your means. It creates options. It creates resilience. It gives you the ability to say no. And the ability to say no is freedom. Freedom doesn't arrive suddenly. It accumulates slowly, year by year, decision by decision. It is built through habits that seem insignificant at the time but compound relentlessly. This is why the early years are so psychologically difficult. Progress is invisible. Sacrifice is visible. The rewards are delayed while the discomfort is immediate. Most people quit here, not because the strategy is wrong, but because it feels unfair. But fairness has nothing to do with it. Markets are not moral systems. They are mathematical systems. They reward behavior, not effort. And the behavior they reward most is consistency. Consistency beats intensity, always. I often thought of investing as a test of character disguised as a financial exercise. It reveals who can delay gratification, who can tolerate boredom, who can think independently. These traits have nothing to do with IQ. They have everything to do with self-control. The tragedy is that self-control is teachable, yet rarely taught. Schools teach algebra but not discipline. They teach ambition but not restraint. And so people enter adulthood financially unprepared, chasing outcomes without understanding process. Process is everything. A sound process removes emotion from decision-making. It relies on rules rather than feelings. It assumes you will be tempted, distracted, and occasionally afraid, and it plans for that. Automatic saving, diversification, conservative assumptions, long-time horizons. These are not exciting tools, but they are powerful ones. The people who win financially are not the ones constantly asking, "What should I do now?" They are the ones who decided long ago what they would not do, and then stuck to it. They decided they would not panic sell. They decided they would not borrow recklessly. They decided they would not chase fads. They decided they would not spend money just to impress others. By eliminating destructive behaviors, they allowed compounding to work uninterrupted. And uninterrupted compounding is extraordinarily powerful. Over time, something remarkable happens. Your capital begins to grow faster than your labor. The money you saved starts earning more than you can save. This is the quiet turning point most people never reach. Before that moment, progress feels slow and fragile. After it, momentum builds. But you cannot skip the early phase. You must endure it. Those who endure are not special. They are simply willing to be uncomfortable longer than others. What separates the few who succeed from the many who don't is not access to information. Today, information is everywhere. Advice is free. Charts are instant. Opinions never stop. Yet confusion has never been higher. That alone should tell you something important. Knowledge is not the scarce resource. Judgment is. Judgment is built slowly. It is forged through restraint, through resisting the urge to act when action feels emotionally satisfying but intellectually unnecessary. Most people don't fail because they choose badly. They fail because they choose too often. The market rewards those who understand that not every moment requires a decision. In fact, the majority of moments require none at all. The discipline to wait is rarer than the intelligence to analyze. I used to say that investing is simple but not easy. The simplicity is deceptive. Save consistently. Invest prudently. Avoid obvious mistakes. Let time pass. Nothing about that excites the nervous system. Nothing about it makes headlines. But it works precisely because it goes against human nature. Human nature wants immediacy. It wants validation. It wants movement. The market punishes those desires mercilessly. One of the most costly misunderstandings people have is believing that risk comes from volatility. It doesn't. Volatility is noise. Risk comes from permanent loss, from leverage, from ignorance, from needing money at the wrong time, from building a life with no margin for error. Volatility feels dangerous, but it often creates opportunity. Fragility feels comfortable right until it collapses. The market does not destroy disciplined investors. It exposes undisciplined ones. This is why I always emphasized financial independence over financial excitement. Independence means your survival does not depend on perfect timing. It means downturns are inconvenient, not fatal. It means you can wait while others are forced to act. Forced action is the enemy of good decisions. People underestimate how powerful optionality is. When you have savings, you have choices. When you have no savings, every choice is made for you. Employers know this. Banks know this. Markets know this. Capital gives you negotiating power with life itself. That power is built quietly, almost invisibly, while you are doing unglamorous things, while you are saving when others are spending, while you are waiting when others are trading, while you are ignoring noise when others are reacting. In those moments, it feels like you are falling behind. You are not. You are compounding. Compounding is not just a mathematical force. It is a behavioral one. Good habits compound just like capital. So do bad ones. The direction you choose early matters far more than the speed. Many people ruin their financial future not through catastrophe, but through comfort. They reach a point where things are good enough and stop being disciplined. Spending rises, saving slows, risk increases. The margin disappears. Comfort slowly replaces caution. Then life reminds them why caution mattered. I watched markets crash. I watched bubbles burst. I watched fear erase confidence in days, and through all of it, the same pattern repeated. Those who survived were not the ones with the boldest strategies. They were the ones who respected risk and prepared for adversity. Prepared people don't panic. Unprepared people always do. That is why I believed deeply in simplicity. Complexity gives the illusion of control, but often hides fragility. Simple systems are easier to maintain under stress. They are harder to break. A diversified portfolio, low costs, conservative assumptions, long time horizons. These are not signs of intellectual weakness. They are signs of wisdom. Wisdom is knowing what not to do. Do not borrow to impress. Do not speculate to feel smart. Do not trade to relieve boredom. Do not inflate your lifestyle just because you can. Do not confuse luck with skill. Do not let short-term emotions dictate long-term decisions. If you avoid those errors, you do not need brilliance. You do not need perfect timing. You do not need insider knowledge. You only need time. Time does the rest. This is why the first meaningful accumulation of capital is so important. Until then, you are vulnerable. You depend on income. You depend on stability. You depend on others. Once capital begins to work for you, even modestly, the balance of power shifts. It doesn't happen suddenly. There is no dramatic moment. One day you simply notice that your money earned something while you slept. And then more the next year, and more after that. Slowly, quietly, ownership replaces effort. That transition changes how you see the world. You stop chasing. You stop rushing. You stop reacting. You begin thinking in decades instead of days. And that shift alone puts you ahead of most people. The irony is that by the time wealth becomes visible, the work is already done. The discipline came earlier. The restraint came earlier. The patience came earlier. The visible outcome is just the echo. People will call you lucky. They will say you were smart. They will assume it was easy. None of that matters. What matters is that you built something durable. Durability is the true goal, not maximum returns, not bragging rights. Durability, a financial life that survives mistakes, that endures downturns, that gives you control over your time, that allows you to act deliberately instead of desperately. That is what investing is really about. Not beating the market, beating your own impulses. I spent my life studying markets, but what fascinated me most was people. Their hopes, their fears, their repeated errors. And after all those years, my conclusion was simple. The greatest obstacle to wealth is not external, it is internal. Master yourself and the rest becomes manageable. You do not need to be exceptional. You do not need to predict the future. You do not need to take dramatic risks. You need discipline, patience, and a willingness to be different from the crowd. Different usually feels uncomfortable before it feels rewarding. If you can accept that discomfort, if you can sit quietly while others rush, if you can build systems that protect you from your own emotions, then time will eventually do something remarkable for you. It will compound your efforts into freedom. And once you understand that freedom comes from capital, not consumption, your priorities change. You stop trading your future for short-term pleasure. You stop needing approval. You stop competing in games that don't matter. You begin playing the only game that does. Build capital, protect it, let it grow, and above all, avoid stupidity. That is the entire philosophy. It worked in my lifetime. It will work in yours.